Okay, well, welcome everybody. We're going to start the webinar, how COVID-19 and the plummeting oil prices have impacted the global storage markets. The webinar consists out of three excellent presentations brought to you by three renowned speakers. First one up is Charles Daly. He's going to talk about the oil industry post COVID-19, some insights and good conclusions on that. After that, Jay Maru from Fortexa is going to talk about floating storage. Really interesting subject right now. Afterwards, Martin Krastev, Executive Director of DC Advisory, is going to talk about investments in tank storage assets in a post-COVID era. So just some housekeeping information. So each presentation will take about 15 minutes. You can ask questions via the section on the right of your screen. There's a tab that says chats, and there's a tab that says questions, so you can ask your questions via those two sections, and we will answer those questions or a selection of those questions at the end of this webinar. So after the three presentations have been finished. There are also two or three poll questions that have been put on the system. You can find them in the poll section. So if you like to give your opinion on those poll questions, that would be great. So that's it. So let's start with the presentation of Charles Daly. He's the chairman of Chanoil, a consultancy company specialized in oil markets and in storage. And he's going to talk about the downstream oil sector post COVID-19. So Charles, the floor is all yours. Thank you.
Thank you, Patrick, and good afternoon, everybody, wherever you may be. Today, I want to tell you that basically this is a personal opinion as to what I think is likely to happen post this horrid scenario that we are all in. I'm going to look at type of benchmarking that can be found, although it's extremely difficult to benchmark this to anything. But then I will also talk about a non-vaccine scenario for the main product grades, and finally to discuss climate change and green markets and how this is going to affect all of us, whether it's refineries or storage installations downstream. In the meantime, please remember that we've got to keep our mind on the fact that history has told us that a pandemic is no new phenomena. During the Middle Ages, there were repeated incidents of bubonic plague, or the Black Death, which decimated Europe. During the 19th century, there were a number of pandemics and influenzas and so on. In the early 20th century, we had Spanish flu at 50 million dead, and recently we've had MERS and SARS. The thing is, and the optimistic view is, that we've always come out of it. And just to give you an idea of this, here is a graph of GDP for the United States from 1820 onwards. And you'll see that there's only one major blip in it, and that was the Great Depression of 1929-1930. But it was a blip, and we carried on growing thereafter. So one can be reasonably optimistic that we will come out of this and we will recover. On that previous chart, you can see that, and the next chart that I'm going to show you is global indebtedness, which will show you how it increased whenever there's been major crises like World War One. World War Two was one of the biggest peaks at about 130% of GDP. And this is GDP including the US, the Netherlands, Japan, Germany, France, UK, Italy, Australia, Canada, Spain, Switzerland, and Sweden, produced by Deutsche Bank. And therefore, it's relatively well represented here. One of the most noticeable things is that it took about 40 years to get back to around 20% of GDP borrowing. Then we had the global financial crisis in 2008. And this is my projected estimate from what I've been able to garner through reading various economic forecasts of where we might end up at the end of COVID-19 at around 110% of GDP. So you'll see that we do have a big job to recover from, and we will. In World War II, which is probably the nearest we can come to for benchmarking, USA and Canada and the neutrals did relatively well as their assets and machinery were not destroyed. The Marshall Plan lifted Europe. The UK did badly because it had incurred the largest debt pile. But from there, the future was up again. And it took, as I said, a good 40 years to bring it down to decent levels. But we are at war again, as against an unseen enemy. We're asking swathes of our industry to convert to manufacturing, in paragraphs, war material. This time not guns, but PPE equipment, ventilators, and medicines. We're effectively on a demand ration basis. No gasoline or diesel consumption, no flying, no cruising, or holidaying. Food and drink is rationed because bars and restaurants are being closed. And our medical facilities have been severely stretched on the front line, with many of the hospital staff exhausted. The scenario without a vaccine, and I'm going to look here on the effect on aviation first. To remain healthy, we're told we must maintain social distancing. This will restrict the provisions of goods and services, which is another form of rationing. And flying is the first to be hit severely. Forget the packaged holiday and the sardine-packed planes of last year. What possible load factor can be obtained if social distancing on planes is demanded? It could be done, but the fares will need to double. When I first wrote this paper some time ago, I said that in order for the airlines to survive, the national states would need to subsidize them or to take over the major airlines. Now, again, benchmarking prior to the 1980s, apart from the USA, most airlines were state-owned. Names such as Sabena, KLM, BOAC, BEA, Swissair, and Alitalia were all names that were familiar to passengers. National airlines. Today, these names have been absorbed and privatized. The nimble smallcomers such as Ryanair, EasyJet, Virgin, Wizz, and Norwegian soon made rapid inroads into the major airlines. All the airlines are now facing up to this challenge with swinging job cuts and redundancies, and also salary cuts. So what will be the future for the airline fuel? Well, apart from the issue of higher fares, how will the public react to being put in an aluminium tube for a number of hours with a lot of people they do not know? They will fear contagion due to proximity. And the myth that in airplanes they say air circulates germs will certainly discourage them, even though that may be a myth. Thus, I think a lot of discretionary travel will be curtailed. Staycations will be more of the norm, and this will result in a drop in demand for jet fuel in the short to medium term. Staycations, as far as gasoline and diesel are concerned, will result in more internal travel. A lot of people are also concerned about traveling by public transport. Therefore, families are likely to go by car. Hotels may also be seen as possible areas of contagion, so camping or caravanning may become more popular. And motorhomes will also probably rise in popularity. The net effect would be an increase in demand for motor fuels. For the shipping industry, how many people would like to go on a cruise after the experiences of the Diamond Princess at Yokohama and the Western Dam in Cambodia, where people got coronavirus and it spread throughout the cruise liners and no one was allowed to go ashore? A number of cruise liners are laid up in various parts of the world. Will they ever be filled again? Surprisingly, about 1 hour ago, I read that Carnival is actually selling a number of its liners which it would have expected to sell in the next 5 to 10 years. The advertising for cruises is now showing 2022 as the availability. And I think the days of the large cruise liners may be numbered. So the shipping industry in general, if planes do not fly their passengers and therefore the cargo that goes in their holds, where would it go? Would passenger planes be converted to cargo planes? We might have to go back to the days of the reefer, the refrigerated hold to carry frozen meat and food, for example, or flowers or other perishable goods. The fears generated by COVID-19 on the global dependence on goods will require production to become nearer to home, and just-in-time economics may already have been blown. The effect of this could mean an overall reduction in bunker fuel demand. Now, primary energy demand, the lockdown initially meant an increase in demand for light and heat, especially in March and April. However, as shops, bars and restaurants closed, so power demand shrunk. The result was further compounded by industrial closures, and the result of demand cutbacks was an overall reduction in atmospheric pollution. As a matter of fact, in the UK, it's just reported that for the last 2 months, they have relied on no coal burning power at all. And this, now we come to the chemical industry. And the chemical industry, here I'm not looking at chemicals as such, but it's demand of the feedstock, which is basically naphtha and LPG, ethanes and such. I think that they're unlikely to be hit that much because goods are still being bought online, and the online shopping growth also demands more packaging. So this might at least provide an outlet for LPG and naphtha that could be surplus in the refineries. The combination of the demand changes will have a profound effect in refinery economics. Now, for the elephant in the room, will the world now wake up to what it's like to be without fossil fuel pollution, and would they like what they see? How can greenhouse gas emissions be brought under control? My preferred view is that only a market-led initiative will cure the ill. At $50 per barrel oil, some wind and solar renewables are cheaper than oil. The major area of resistance is transport fuels, and only when there is, one, a surplus of margin electricity, renewable electricity, available, and secondly, when further R&D technical steps will give alternative fuel its ability to replace internal combustion engines. Remember that the energy that's generated by gasoline and diesel is about 110% of the energy currently generated by power stations. COVID-19 has given the world a chance to draw breath. I believe it will cause the world to embrace the change to renewable power with greater vigor. So we're coming up to COP26 in November, I believe, and for the market to create the technology to deal with carbon emissions, there needs to be a financial incentive. It cannot be done just by wishing it from the various young brigade that we get knocking on doors. This can only be done in the form of a suitable price for carbon reduction. Carbon capture and storage technology is there, as is battery technology and other methods whereby we can get grid scale renewable energy. To smooth out the intermittency of wind, solar and similar technologies, we need grid scale batteries, and we need all the carbon capture emissions that we can. And all these emissions need a trading system that is genuine and realistic. Will COP26 please take note? The major changes we identified are increase in gasoline, decrease in jet, increase in diesel, decrease in bunker fuel, and a possible increase in LPG as a chemical feedstock. How will this affect refineries? Simple hydroskimming refineries will almost certainly experience reduced runs. Hydrocracker severity will change to reduce jet fuel make and increase diesel production. Cat crackers and reformers will be maxed out to meet the increased demand for gasoline. And residual bottoms will need to be low sulfur to meet bunker fuels. Coking will be probably still give the best returns, as heavy fuel oil will still need to be destroyed. In conclusion, my view is that without a vaccine, we will be still operating at a reduced rate with fuel demand below historic highs. Some increase in demand for gasoline and diesel will be shown as we take staycations. Cruise liners and airlines will be busy to drive solar and wind. The drive to solar and wind, will accelerate, as will the development of the electric car. And the future has to be green and sustainable, and thus fossil fuels will have a finite time as the means of driving economic growth. Crude exploration has been very successful in finding new large deposits around the planet. Think Guyana and Suriname and places like this. The question is, will they be stranded, specifically sour crude production? It has to be all about light, low sulfur fuel oil for the moment to meet a lower cost of production. We're currently seeing oil demand peaking and possibly regressing. Therefore, no amount of posturing by OPEC and Russia to tell us how much they're going to cut or not cut will change the equation. If demand is not there and all storage is full, there will be no nominations to lift the crude oil. Thank you very much.
Well, thank you very much, Charles, for this insightful presentation. As said before, questions will be answered related to this presentation at the end of the webinar. So now we will go to the next speaker, Jay Maru of Vortexa. Vortexa is an advanced ship tracking and cargo tracking company, and well equipped to keep track of floating storage and changes in trade flows. So yes, I give the floor now to Jay. So please go ahead. Thank you.
Hi, thanks, Patrick. Hi, good afternoon, everyone. I'm Jay, and I'm a senior market analyst at Vortexa. So to those who may not have heard of Vortexa before, we're an analytics provider that tracks the movements of oil and gas globally. And today I'd like to share some thoughts with you on floating storage and changes to trade flows. So to start with, I guess the first question to ask is, why does floating storage matter? Well, floating storage is something that's been in the news a lot recently. And within the past few months, we've seen waves of interest, especially from the oil industry. And at Vortexa, what we do is we combine data with human intelligence and machine learning models, and we use this to produce floating storage information for the market. What I think is that it's never been more important than it is now to be able to quantify floating storage, as floating storage provides one of the best indications of the tilt that there is within supply and demand. As I'm sure many of you know already, floating storage is typically one of the most expensive ways to store oil. So it will be extremely sensitive to price movement. So any changes that we see in floating storage are particularly interesting when there's an increased amount of volatility in the market. So what am I going to cover today? So today I'm going to look at the current market situation. How did we get there? And floating storage, the current state of it, how much there is, what products there are, and where they're being stored. I'm also going to talk a little bit about some of the trade flows that have changed as a result of floating storage. And then I'll quickly touch on what the next steps could be. So if we wind our clocks back to the start of the year, in the first quarter, news broke out of COVID-19 and the spread of it initially in China, and demand naturally pushed lower there. This demand destruction then began to spread across Asia and then globally as well, along with the spread of the virus. Interestingly, shortly afterwards, we heard some more news from the oil market that there was a change in policy from the likes of Saudi Arabia and Russia to boost exports in a bid to claim market share. Now, the result of these two things happening together was fascinating, because at a time where demand was already on the decline, we saw a surge in supply. And what happened is that the prompt prices in the oil market were crushed relative to later delivery dated prices. And so this created what's called a contango. And so we first saw this contango really open up on crude oil, and then we saw it open up on refined products as well. And so as this contango widened, there became this rush of interest from oil traders to snap up tankers for floating storage. And then the result of that, of course, was that freight rates also rose. So one thing I'd like to say before we really delve into floating storage is that floating storage isn't something that's new. It's something that's always existed as part of the oil market, and it exists for a variety of operational and logistical reasons around the world. Specific examples include places like the Black Sea, West Africa, and more recently in Singapore and Malaysia, as a result of the change to low sulfur bunker fuels from 2020 onwards. So the reason why I've put this chart here is to show that between March 2019 to March 2020, there's been a steady-ish range of floating storage in the world between around 40 to 80 million barrels. And that's been even the case when the difference between the second month and the first month ICE Brent futures, which is the black line there, that difference has been relatively negative for most of that period, yet we've still seen floating storage occur. But what we saw in March was as this conflux of demand decline and supply rise arrived, we saw this negative price flip into positive, and so we saw this huge contango emerge. And what that means is that there was this strong commercial incentive to put oil on the water. And so I'm highlighting this period in March here specifically because that's when the Brent time spreads flipped. But also this was when we were first hearing that people were actively looking for tankers to book for floating storage. And so, yeah, as I said before, from this period, that's when the freight rate started to go up. And then what we saw next was actually unseen for many, many years. So as we can see from that red line onwards, we can see a huge rise in floating storage, and that's for crude and for clean products. We can see that crude floating storage jumped from around 50 million barrels prior to March to currently close to 170 million barrels. On clean products, so things like gasoline, diesel, and jet fuel, that volume rose to around 90 million barrels. But I think it's also interesting to point here that while we saw a rise in crude and clean products, the rise in floating storage for dirty products, so things like fuel oil, that hasn't been as pronounced. Actually, it's remained relatively stable. And this is quite interesting because I think what it underlines is that while we saw demand for gasoline and diesel hit massively, demand for bunker fuel was more tempered. And that's maybe why the floating storage rise on dirty products wasn't as pronounced. But I'll touch on that more later on in the presentation. So we've seen how crude and clean products floating storage has risen globally. But now let's look at how things look on a more regional basis. So here I have a breakdown of crude floating storage by region. And the first thing that you can see from this chart is just how big the volumes are in Asia relative to the rest of the world. So you can see by the total volume and the level of growth, Asia is huge for crude floating storage. And this is crude floating in places like Singapore, Malaysia, China, India, and Indonesia as well. And I guess that's what you'd expect, given that within China and then within the Far East Asia region, that's when we first saw that hit to crude demand as a result of COVID-19. I've highlighted a section within that line of the Asia trend just to show that there was a little bit of a decline in May, but then it started to rise again. And this is quite interesting because I think it ties with this idea that crude was bought cheaply en masse within Asia and especially China. But now we're starting to hear of congestion within some Chinese ports, especially within the Shandong province, and potentially the slight decline in freight rates from their peak has refreshed some interest in floating storage. Looking towards Europe now, and that's the more wider oval shape that I've got towards the bottom half of the graph. You can see that the volume of crude in floating storage across Europe has been relatively flat since April. So that's crude being stored in places offshore the UK coast, places like Southwold, also in Malta, Greece, Denmark, So that's another interesting trend, which is quite different to the one we've seen in Asia. I'd also like to point out North America as well here. Maybe it's a little bit trickier to see, but you can see the dark green line kind of break through that circle recently. So you can see like a sharp decline recently for North America crude floating storage, which is mainly down to the US. And I think what's happened here is that since we've heard that big news of WTI falling negative, what's really been happening is that production has really fallen, and you can see that from rig count numbers from the IEA, which have fallen sharply in recent weeks. So less oil is being produced in the US, and as a result, less is going into floating storage too. So this is kind of a summary of what's happening on the crude situation. Let's turn our attention to clean products for a moment. So what I've got here is clean products floating storage in a few selected regions. These are the regions which have amongst the largest volumes of clean products floating storage. And so I've highlighted Europe, Asia, and Central America. So starting with Europe, what you can see is a high volume of gasoline, which is in floating storage offshore Europe. And what that reflects is just the fact that as a region, Europe has typically been struggling to get the gasoline out from Europe and send it to places like the US and West Africa. You can see diesel is a little bit more toppy, but that also reflects this sluggish demand that we've had in Europe as a big diesel consumer. And on jet, you can see an increase, a trend upwards, and that's partly linked to arrival of really large tankers of jet coming over from Asia into Europe, and especially the example of a very large crude carrier sitting offshore the UK laden with jet, which is quite a rare phenomenon actually. So turning our attention to Asia, you can see that it's a slight different profile. There you can see plenty of diesel in floating storage relative to gasoline, and that reflects this reflects the fact that as a region, Asia is a lot more longer on gas oil than Europe is, and so Asia as well is kind of struggling to get its diesel out from the region. On gasoline, you see that it rose really quickly, but then there was a sharp drop down, and that's reflective of the recovery which is taking place in Asia in terms of more people getting on cars, getting back to work, and that's what's helping the gasoline drawdown in floating storage. And then finally, turning our attention to Central America, you can see quite a symmetrical profile between gasoline and diesel, although gasoline is slightly higher, which is what you'd expect given the consumption profile of Mexico especially. But that sharp rise which we saw earlier on in late April, that reflects a large amount of US PAD 3, US Gulf Coast gasoline sitting offshore Mexico's east coast as Pemex, Mexico's state oil company, declared force majeure, and that decline that we see after that is a result of these US Gulf Coast refiners trimming back their production, and so as they've trimmed back production, the volume floating offshore Central America and Mexico has fallen too. So we've seen some interesting changes to floating storage. Let's turn our attentions now to how things have changed on trade flows. So starting with middle distillates, one of the most interesting things with middle distillates that we've seen is a larger volume of tankers taking longer routes to get to their market. So here I've got a chart showing Northwest Europe and Mediterranean middle distillate imports. And these are imports that have traveled around the Cape of Good Hope. So typically tankers of jet and diesel that come from the Middle East, from India, from Asia, typically they travel through Suez because that's the quickest way to get to this market. But increasingly we've seen, especially in the months of April, May, June, more and more of these tankers are traveling the longer way around. And that kind of adds to this view that you want to delay discharge as much as possible to maximize your benefit from the contango. But also by taking this longer route, there is the potential option for you to discharge potentially some or all of your cargo in West Africa, in Latin America, maybe not so much now, but previously when the COVID outbreak wasn't so severe, or maybe into storage in the Caribbean. So that's quite an interesting phenomenon we've seen since floating storage has taken off. And then on jet fuel, we've also seen, as I mentioned before, very large crude carriers load for the first time with jet fuel from South Korea for their maiden voyage. And typically we saw this in the past with diesel for flows coming from South Korea and from Singapore into Europe. But now we're seeing it with jet as well. And that ties into this idea once again that storage for jet fuel in South Korea especially was really tight. And so emptying that out onto a VLCC is one way to make some more space in your tanks. So let's look at light ends now, and within light ends specifically on gasoline blending components. So one really interesting thing we've seen here on gasoline is that China has imported record volumes of blending components in May. And you can see that in May, that figure is close to 1.3 million tons. And that's well above previous months, even in past years. So on one hand, you've got this story of China improving and having a recovery in their demand. But besides that, there's also another key factor, which is the way Chinese gasoline is priced. And so as crude prices fell, it created this windfall on refining margins for independent refiners. And so they imported blending components at record numbers to kind of secure these huge margins, because gasoline was tied to a crude price which was floored at around $40 a barrel, I think. So anything lower than that on crude just made refining and producing gasoline hugely profitable for some refiners. We actually even saw some Refimet come all the way from Europe to China as well. So Refimet's another blending component. And that's really unusual given that Europe is typically exporting such components to normal outlets such as the US and West Africa. So for it to go to somewhere as far as China really reflects how things have changed in this world. And so the final trade flow I'd like to talk about is on crude. And on crude, I like to talk about a very specific section, which is heavy sweet crude. So these are quite a rare portion of the overall global crude barrel. And most of these heavy sweet crudes come from West Africa, and they're known for having a high residual fuel oil yield, but also being very low in sulfur. So really useful if you want to make things like VLSFO, so 0.5% IMO 2020 fuel oil. And so what we saw was, as freight rates rose, especially on the largest tankers, it really made it much more expensive to take crude from places like West Africa to China. And as a result of that, we saw Europe import record levels of heavy sweet crudes. And this also had another benefit for European refiners as well, because importing these crudes is obviously a really good way to produce 0.5% bunker fuel. And actually some of the cargoes that we saw, some of the volumes that we saw head into Europe in May was also triggered by the startup of a facility in Wilhelmshaven in Germany. And that facility is being run specifically to produce VLSFO. So I think with that, I'd just like to summarize what we've covered today very quickly. So the key takeaways are that floating storage has reached record levels on crude and clean products. We've seen hotspots emerge for activity in places like Asia, Europe, and Central America. And though we've seen a bit of stabilization across the board, volumes in Asia have been climbing a little bit as well. Looking ahead, we also saw some changes on trade flows on crude and products, especially on long haul routes. And then if we look further ahead into the future, what could happen to bring down floating storage? Well, either it's a combination of increased demand as more and more people come back to work and economies recover, or we'll see increased run cuts from refiners and that will help draw down the floating storage inventories we see today. So with that, I'd like to conclude, and I'd just like to say thank you for taking the time and listening to the presentation. Happy to leave my email in case you have any questions, or if you want to talk about our data, and I'll pass it back to Patrick.
Okay, well, thank you very much, Jay. Very detailed, insightful presentation on a well, definitely interesting subject. So now we will go to Martin Kastev, Executive Director of DC Advisory and Investment Advisory Company. He's going to talk about investing in oil storage post COVID-19 and in the age of decarbonization. So Martin, please go ahead. Thank you.
Thank you, Patrick, and good afternoon to everyone else attending the webinar. I'm based in London, so it's good afternoon for me, and I know that everyone else has different time zones. Very quick housekeeping. I'm required to kind of make this statement that all the views which I am presenting today are my own personal views, not the company views. And also would like to kind of point out here that almost entirely here through the presentation, I'm presenting my views on Europe as a M&A and investment destination. So I'm not covering the rest of the world. A very big background. I work for DC Advisory. DC Advisory is the mergers and acquisition advisory and debt advisory brand of Daiwa, the Japanese financial institution and investment bank. And we're global. We have offices throughout the world. I sit in London, and I sit in the infrastructure coverage team, and I almost entirely focus on energy. And energy for me means oil and gas midstream, including oil and gas storage and regas terminals, waste energy, biomass, and other renewable technologies, and also the newer technologies related to smart grids, including smart meters and electric vehicle charging stations, and so on. So as part of my job, we cover with DC Advisory, Infrastructure Advisory, we cover probably around 100, maybe just north of 100 infrastructure investors, both funds and direct investors, pension funds and insurance companies. And before this webinar, I did a bit of research on the main kind of investments that some of our clients and some of the funds who we cover have made in the space of oil and gas storage or oil and gas midstream. And I've listed them here on this slide. This slide is not inclusive, so I've shown 17 names here in terms of investors. There are others who cover Europe, and some of the investors who we cover have made investments outside of Europe, and that's why they're not listed here. But I think the importance, which I'm trying, the point which I'm trying to make here is that out of 100, we're aware of probably 20 to 25, maybe north of that, names who have made investments in the storage and energy midstream space, which is a significant number. So it's quite significant proportion of the investors have shown interest and have made investments in this space. One other observation on this slide is that many of these assets, many of the investments are platforms. They are large companies, multi-assets, and when the investors were making these investments, they have seen this as a growth platform. So the original business plan, included growth from organic and bolt-on acquisition kind of sources. which is important for the rest of the presentation. It's a point important for the rest of the presentation. What's interesting is that almost all of these investments were made after 2012. In fact, most of them were made after 2014. But what I'm trying to show here is that, before 2012, there was almost no investments. There was no very, very limited deals where an infrastructure buyer was acquiring an oil storage asset, for example. Most of the investments happened after 2012. And before 2012, the financial investors in this type of assets were mainly higher risk, higher return type investors, such as private equity funds, some dedicated energy funds, most of them based in the US, not all of them, but most of them based in North America. And since then, there've been kind of quite a lot of deals in the space. And what's important is that a lot of the sellers were strategics. In the last 7-8 years, most of the sellers were strategics, larger corporates. Where we sit today in 2020, in the middle of COVID-19, just emerging, certain regions in the world are just emerging from lockdown. What this crisis has proven is that this is a very attractive sector from purely financial economic point of view, right? In a period where there's been a very substantial decrease in oil demand or oil products demand, as well as very significant reduction in GDP in almost everywhere in the world, this sector has performed relatively well. And infrastructure funds and direct investors who invested in this space should be quite happy with their investments, because the reason why infrastructure emerged as a dedicated investment team back in the early 2000s wasn't exactly for that reason, to find an investment sector where you can invest capital which will perform well in a financial crisis or in economic crisis. And to date, most of these assets have performed well, mainly because they're contracted medium to long term, most of them, and because COVID-19 created not just COVID-19, but COVID-19 accelerated a contango market, which usually is very good for storage. Now, having said that, how do we see the period after 2020 going forward? And this is a new team which has emerged in the last 18 months, actually. It's not COVID related. But what we see in the market is that more and more clients who are considering investing in storage, they're asking us, what is the ESG angle here? Environmental sustainability and governance. And most of these funds or direct investors, they get challenges from their own investors, the LPs in the funds, on are they deploying their capital in greener and more sustainable future. And we as an advisory firm are more and more asked to write papers on sustainability of oil storage. So a key area of concern has been raised decarbonization, and some of our clients have indicated that there needs to be very specific reasons why they should consider investing in anything related to oil storage, oil and gas. And that means storage upstream, downstream, across the chain. So in terms of trends, I mean, I talked to some of these, the first bubble here, which is the ESG and the emphasis on decarbonization. What that means is that it's likely that going forward, we're going to see less, fewer first-time buyers in the space. So there will be some, there's no question about it. The number of new funds in the infrastructure space and the new type of investors emerging in the space, is increasing, and some of the new funds would, and existing funds would continue considering investments in the space for first time. But what we think is that in the future, especially when we talk about 1, 2, or 3 terminal, portfolios of 1, 2, 3 terminals, we think that these transactions would be, more of a bolt-on acquisition for an existing platform, some of the platforms listed on the previous slides, rather than a new financial buyer coming and bidding aggressively for these type assets. When some of the platforms listed on the previous slides come to market, and to my knowledge, none of them is coming in the next 12 months. But when some of these guys come to market, when, for example, the original investor reached end of life, the maturity of that fund comes, we do think that there will be some interest from larger pension funds and infrastructure directs. But we do see the consolidation team more relevant rather than the new times buyer. Now, what does that mean for valuations? We have seen some really, big multiples in terms of valuation in the last 24, 36 months. I don't know if we're going to continue seeing this type of valuations again. We have a poll which is ongoing, and we've asked our audience where they see going forward the valuations. My view is that the valuations will remain relatively high, but probably slightly lower than what we've seen historically, mainly because I think the new investors, the number of first-time buyers who are willing to pay platform premium is in our view and in my view is lower going forward. And then, very, very quickly, I'm running out of time, but what investors want, right? So definitely some form of conversion to renewables. Investors want to see the proportion of the exposure to dirty fuels compared to biofuels or renewables increasing over time. So the renewables and the biofuels, as a proportion to increase over time. Historically, vegetable oils and chemicals have been perceived very well by investors, especially long-term investors. Chemicals are facing some scrutiny, mainly in relation to plastics and consumption of plastics and plastic pollutions, specifically in the oceans and the rest of the environment. But overall, we do see chemicals as a stronger kind of product line, more attractive product line for investors compared to fuels, and that's just the nature of it. And then everyone is kind of focused on the long-term nature of the cash flow. So one of the key risks, what people are worried about is, when they buy into this sector, when the time comes, how they exit, who they're going to exit to, and therefore investors are focused on either long-term contracts or some form of a history of multiple renewals of contracts. And historically, that works very well if the terminal has a strategic location integrated into the supply chain of their customers. Although the contango market, has made and is currently making probably a lot of money, the infrastructure investors don't like a lot of exposure to contango in general. It's something that people are shying away. And then, all the other items listed on this slide are a plus. Terminals with diverse set of modalities, multiple contracts rather than a single or two major contracts. Historically, I mean, I know some of the views on jet fuel expressed on the slide. Historically, investors like jet fuel better than ground transportation fuels. I think if you think about the infrastructure investor community, many investors have very substantial exposure to airports. A lot of the infrastructure guys, especially the larger funds, own a lot of airports. And I think the overall long-term view is that the transport market, including aviation, will go back to normal in the medium term. And then the final point is location, something that we borrowed from the real estate market. Our Antwerp, Rotterdam, and Amsterdam still seen as a premium location. Now, having said that, there are certain locations in Europe which meet some of the criteria in the other bubbles on the left, who are very, very attractive assets, and people getting comfortable, mainly because again, integrated in a specific supply chain, which makes those terminals sustainable, and you can see long-term cash flows going forward. Thank you very much for listening to me, and please ask me any questions which you may have, and I welcome everyone to get in touch.
Okay, Martin. Well, thank you very much for your insightful presentation. Really good. So we now come to the questions and answer section of this webinar. We've received a lot of questions via the webinar section questions. So let me start with Charles. Question for Charles. The view on the refinery industry in Europe given the current pricing. Charles, maybe you can unmute and try to answer this question. So what's your view on the refinery outlook?
It's an extremely, thank you, Patrick. It's an extremely difficult scenario to try and forecast, and I know that I tell most of my clients I try and not forecast, because forecasts are always generally wrong. But in that context, I think what we had before this COVID-19 struck was in fact a vision in Europe of already a reduction in demand. We had plateaued and we were on the way down in terms of demand. I think technology always surprises on the upside as to how quick and fast it can be. So the EV car, the hybrid, as an interim, is going to drive substantially faster, I think, than people think. Battery technology, as I said earlier, is improving enormously, which will give the sustainable green energy market the edge in terms of levelized cost of electricity, and therefore the EV car will become a more easier thing to run. There was a piece of news the other day about a battery in China which doesn't need lithium and doesn't need cobalt and has a 1,000,000-mile longevity. That would revolutionize the EV car market. So if you're looking short to medium term, I think we'll probably see a bit of CDU capacity being closed in. I think we'll see the hydrocrackers looking not as profitable as they were in the past, and I see cat crackers and cat reformers being the place where there'll be a big demand for, and therefore a substantial, what I would call a B2B component movement. And that's where I think the storage industry will be impacted quite a lot, because components will start to move, which will go into refining processes like cat cracking, for instance, in the vacuum gas oil side, and reforming of naphthas. So I think generally Europe is going to decline in terms of refining capacity, medium to long term, and I think the shape of the refinery will change. As we saw with IMO 20, as soon as we got 0.5 sulfur coming in and the price went above crude, hydroskimming refineries started to become very profitable, whereas everybody had written them off. So trying to forecast what's going to happen is an extremely difficult scenario.
Okay, thank you very much, Charles, for your views. So now let's go to Jay, a couple of questions for him. So first, well, a short question on the typical anchorage areas in Europe for floating storage. Maybe you can elaborate on that. And after that, I have another question. So please hang on.
So in terms of typical storage areas, yeah, southward of the UK has been the home of a lot of diesel and jet fuel recently. We've also seen a lot of tankers hold offshore ARA ports. And what we also saw at the very start of floating storage was when tankers would load diesel and gas oil from the Far East, as they would pass through the Suez Canal, they'd hold in Malta for a little while before then deciding whether they want to eventually store closer towards the Med market or towards the Northwest European market. So those are the main regions, anchorage areas that we're seeing for CPP floating storage.
Okay, thank you very much, Jay. Another question: what is the ratio between floating and total storage for each region? I don't know if you can answer that question.
Yeah, so I think that's a tough question to answer because I don't have the total storage capacity volumes at the moment with me. But what I would say that is in the grand scheme of things, the outright numbers for floating storage are still relatively small compared to how much storage capacity there is in the overall oil market. That's a fact. But what's important is that this relatively small amount that is being held offshore has an outsized impact on what's happening with trade flows globally. So I'd say that the percentage will be small, and though there will be variations in some regions, it's not so much the percentage that's important. It's more what is holding there, and whether the trend in what's being held is going up and down.
Okay, one more question, quick one maybe
Sure.
from my side. So if you look at the total tanker fleet, how much of a percentage approximately is tied up in this floating storage?
Yeah, so this is a great question, Patrick. It's really interesting when you look at this from the perspective of fleet utilization. You see there is a quite amount of stratification depending on what tanker class that is. So on VLCCs, we saw the amount of tankers being booked in floating storage peaked to almost like I think 16 to 18% of the total VLCC fleet at one point. Now that number has come down, I think closer towards 10% or something like that. On the smaller tanker classes, so I think Handymax MR tankers, that's where the fleet utilization for floating storage was lowest. But even then, that peaked, I think, to closer towards 11 or 12% as well. I can't remember the exact numbers off the top of my head, but those are the kind of ranges we're talking about. So this figure, these percentages are really what's been driving freight rates recently.
Okay, thank you, Jay. So now moving on to Martin, a couple of questions there. So if you look at the investment appetite and you compare storage of biofuels and renewables in Europe versus the US, where do you see more appetite? And please unmute, Martin.
Yeah. I think in both situations, it depends who the off-taker is, and how your terminal fits into specific supply chain. There is a demand in Europe to diversify from fuels and other oil products. So for a pure standalone biofuel terminal, I think there will be significant demand in Europe for this type of terminal. It's difficult for me to compare to the US because I don't know the US market that well, but in Europe, I believe that if you have the good fundamental contracts, or even if the contract is not super long term, but there's a clear path to have a portfolio of clients or renewal of contracts. For example, if it's it's fitting a certain investment team or certain industrial team, I believe that there will be substantial demand for that type of terminal.
Okay, thank you, Martin. Another question. So if you look at the main risks for investing in terminals, in the terminal business in Europe, what do you perceive as being the biggest risks?
Yeah. So when we discuss this with potential investors, potential buyers, the group of risks, I can't list all of them because it's always very kind of terminal specific, but the group of risks we see is technical and environmental. There are a lot of old storage tanks in Europe. There is a specific case, probably almost 10 years ago now, slightly less than 10 years ago, where one of the major terminals in the Aarau region was shut down for a quite substantial amount of time. Some of our audience know exactly the terminal which I'm talking about. And as a result, they lost a lot of their key customers, and from a financial point of view, it was not a good investment. There are some terminals which are legacy terminals with a lot of kind of old tanks which require upgrade, or even to meet some of the newer regulatory requirements. And as a result, that's one of the major risks. Another risk is obviously contractual and commercial structure. History of renewal, what's your exposure to a single client, single off-taker, what's the creditworthiness of that off-taker, how easy is to replace an off-taker. Regulatory is another risk group, regulatory risks. Europe obviously is moving very quickly towards decarbonization. So when I say regulatory risks, I mean, one good example is the diesel scandal from a few years ago, involving some of the big car manufacturers, and suddenly, you lose big chunk of of demand for diesel, and therefore impacting your certain terminals. And so going forward, with electric vehicles and so on, sustainability, and then specifically what I mentioned earlier, from an exit perspective. So, a lot of these terminals, there's a question about terminal values, and, some terminals, some of the deals have been done at quite high terminal, quite high EV to EBITDA multiples. And the reason is that, the investors have assumed certain terminal value at the end of their fund life, or, at the end of their investment horizon. But that terminal value is only going to materialize if there is a sustainability story around the terminal. And finally, the other risk is future liquidity for these assets, and it's basically what I've mentioned, that when the time comes to sell the terminal, who you're going to exit to, who is going to buy it from you. So that's another risk.
Okay, thank you, Martin. I saw a question that I might be able to answer. So what's the impact on storage investments in Europe, under the current circumstances? So if we look now to say investments in expansions or new terminals, currently as of now, we don't see a real big impact on investments. So planned investments are still being carried out, maybe a little bit delayed due to corona measures and social distancing. But other than that, investments and planned expansions and even new terminals, they are still being built. And especially with the, let's say, the more uncertain planned and announced terminals, I think there is more interest right now to try to get investors and clients on board, looking at the current market circumstances, which are pretty good for terminals.
Yeah.
Okay, so another question for Charles. When do you see the jet fuel demand recovering? That was one question from the audience. Maybe you can try to answer that one. Thank you.
I wish I knew, is the answer to that one. I'd take a long bet on it otherwise. But I suppose if you think in terms of the way that people react to major changes in system, we've seen so many in the past 40 years. With invasions in Iraq and Kuwait and wars and God knows what. It usually is a function of stock, one. Two, it's a function of confidence. And most of those, generally, people forget after about 6 to 8 months. So if you think that we're out of this COVID crisis and we don't have a second spike, then within the beginning of 2021, we'll certainly start seeing movement in people moving around and want to visit their families and friends again. So if you say anywhere between 6 and 18 months is probably the best you can guess on this.
Yes, thank you, Charles. Yeah, and you're right. It's always hard to predict such things. Okay, so let's go back to Jay. I think we still have some time to go, so I'll try to do a sort of a second round of questions and answers. One for Jay. So the clearance of gasoline, the gasoline glut in Europe. Do you expect that to happen soon? If you look at the current US stocks for gasoline, they're quite high, but normally this time of season, there's the gasoline goes to the US as a sink, where demand is high during the summer driving season. Well, obviously this is not happening, or it's different this year. So what do you think it will happen or not? And what if it doesn't happen? And will that impact the European refining sector?
On the first part of the question, whether I think that the stocks will go down, my personal opinion is that the stocks, at least offshore Northwest Europe, they should fall from current levels on gasoline. The reason why I say that is kind of like a chain of events. So what's really important to watch here is what's happening in Latin America, especially in countries like Brazil, and Mexico, because the US is a huge exporter of gasoline to those countries. And so if we see a huge increase in the amount of cases in those regions, and we see gasoline demand really dip there, then we'll have a chain effect where the US will export less, so they'll have more for their domestic market, and then the propensity to export from Europe to transatlantic markets will also decline as well. But given that the rhetoric in Latin America, especially Brazil, is very much at the moment, let's keep the economy going, and let's try to minimize transport restriction. I think that the impact of such lockdown measures won't be that pronounced. And so, as you mentioned before, gasoline demand kicking in the US as well for summer driving season, I think that could actually potentially surprise to the upside, especially given that jet fuel demand will be lower, given that people are less keen on flying and more keen on probably going in their own cars and traveling around various parts of the US. So my opinion is that the gasoline offshore Europe, I think that's more likely to go down than go up from where it is at the moment. The second part of that question was what would happen if levels kind of stayed the same or they went up. Well, I think if that was the case, then you just have to see deeper run cuts from European refiners. I don't think European refiners are not anywhere near max gasoline mode, so for them to really minimize gasoline production even more from current levels will be tricky, and so they'd probably have to cut runs at an earlier stage of the refining process from where they are currently. So yeah, I think that's probably the next step that would need to happen.
Okay, well, thank you. So maybe some short attention to the poll results. So if you go to your the right section on your screen and click on the polls tab, you can see the results so far. So our first question, I think it's relevant for Martin's piece of investing in oil storage. So what are the multiples on storage sales? What do you think they will be currently as compared to 3 years ago? So we see a consensus building that the multiples, so the EBITDA multiples, will be either maybe on the lower side of the spectrum, so either 10 times or less, or between 10 and 12 times. That's the current, let's say, consensus of the public. Maybe Martin, you can comment on that. What do you, how do you view that? Or maybe you don't want to comment. I don't know, but
yeah. I mean, look, I voted 12 to 15. If anyone is interested. My view is, look, historically, the multiple have been 13 to 14 times, depending obviously which horizons you take, and there is massive difference terminal to terminal, right, or portfolio to single terminal, and so on. We have seen some quite high multiples, like high teens, north of 15, 16 times. Where, again, I'm talking only about Europe. I'm not talking about North America or rest of the world, where the markets are different. And, I know the valuations are probably lower in some of these jurisdictions. In Europe, where we've seen multiples of less than 10 times, these usually are terminals with legacy tanks, terminals which require quite a lot of environmental capex to be spent in order to continue operating. So there have been a couple of transactions in the sub 10 times space. My view is that going forward, the multiples will be lower than what historicals have been. And I said historically, I think on average is 13 to 14 times. I believe the number is, but I don't think it's substantially lower. So that's why I voted 12 to 15, and I think that, you know, if it's sub 12 times, probably there is no growth in the terminal, and probably there is substantial capex to be spent on upgrading the existing storage tanks.
Yeah. Okay. Clear. Okay. The second poll question: which of these factors are most likely to drive floating storage levels up or down within the next 6 months? So the first, let's say, option, the most likely option, according to the audience, is an uptake in demand. If you assume that the lockdowns will gradually be ended, and that makes sense. So demand will recover, and given the fact that OPEC has come back on its output, you will see a gradual tightening of the market, and thus the narrowing of calendar spreads, and the unwinding, or let's say unloading, of all this floating storage. So it makes sense to me. Second, let's see. Oh wait. We also see a sort of a second wave of the pandemic, which is also a very likely event. It's even more likely, according to this to this audience. You see it in your environment, right? So people are getting more loose on the social distancing rules, and that may lead to a second wave, and potentially more lockdowns. Although I think governments are a little bit wary right now to go back to the lockdown situation, given the severe impact on the economies. But, yes, so in that case, floating storage levels might go up again. So maybe Jay, you can comment on these options. What is your view?
Yeah, thanks, Patrick. So just looking at these options, I think the most likely factor to drive floating storage at the moment, as things stand, I think it's uptake in demand. So obviously I have a biased, like, regional centric view, and I'm sure our listeners listening in other parts of the world outside of the UK or Europe will have different views on this. But just from where I am now, given that the general sentiment seems to be that the number of cases for COVID are generally going down, the push is to get more people mobile, back into work, get the economy going again. I feel like that's the most likely thing to happen as things stand. And so that increase in demand that we see as more and more people start traveling, driving their cars, that increase should really wind down floating storage on refined products. And then as we see the wind down on refined products, we also see it on crude as well.
Okay, Jay. Well, thank you very much. So looking at the time, I think it's it's about time to end this webinar. I want to thank all the speakers, Charles, Martin, Jay. Thank you very much. Also want to thank Tank Storage Magazine and Easy Fares for organizing this webinar event. I think they did a great job. I think the slides will be sent afterwards to all the participants, and if somebody didn't make it, they can also receive a recording of this webinar. Again, thanks everybody, and let's stay in touch, and hopefully everybody stays safe and healthy, and hopefully we can get all started and go to work soon. So thanks everybody, and
Thank you.
bye bye.